Hello, Mark Ostwald from ADM Investor Services International with some thoughts this week on where we stand with all this global debt growth and the calmer tone ostensibly to financial markets. I want to start with a chart of from the IIF, which provides all the data that we get every year on global debt growth. As one can see, we've seen a spectacular growth in all forms of debt over the past 20 odd years. That reached a peak of 255 trillion in 2019, a growth of 10 trillion on the year. Perhaps the most interesting aspect of that IIF data is the fact that they note that in March alone, issuance by the major government bonds in terms of major government bond markets was 2.1 trillion. When one compares that with last year's total growth of 10 trillion, that's a size, gives us an idea of how much we've got in terms of global debt growth. Which brings me to my next chart, which is a chart of the G20 COVID-19 stimulus plans around the world, obviously very much led by the United States with its 2.3 trillion. But as one can see, basically what it implies is a massive amount of growth in global debt on top of what we've already had. And I think that's the point to be borne in mind. At what point do we actually reach some sort of asymptotic level of debt growth where we need to start considering whether a debt jubilee of some form or another is going to be necessary? That's a problem for a post-COVID-19 peak to sort out. The next chart is just pretty much the same sort of thing, but just to emphasize how quickly US debt growth has surged in the last month or two, and that it's going to continue surging over the next couple of months. My fourth chart now basically says we've got all these central bank measures out there at the moment, and they are basically exercising a calming effect. But the global shortage of dollars is still very much in evidence. And one chart which demonstrates this quite well still is the US dollar FRA OIS spread chart, which we've looked at before. There has been some easing of tensions in that since the end of Q1, but it's far from out the window. And with the World Trade Organization predicting that global trade is going to contract somewhere between 12 and 32%, can't be very accurate about this, in 2020. The surplus of trade dollars is going to shrink as well, and people will still carry on hunting for dollars. So that is a problem which goes on in the background and I don't expect to ease. My fifth chart is basically easing of market concerns on everything. It is the US high yield bond spread versus the S&P 500, which we've shown many a time, and as one can see, remain very well correlated. The easing of the high yield bond spreads, albeit to still very, very wide levels by any historical standards, has allowed, along with other measures and the feeling that we've had a big enough sell-off, the S&P 500 to recover quite smartly. However, I would still stress that in my view, particularly when one considers my final chart, that volatility is very much here to stay, and that people should not be necessarily thinking of anything more, as I said last week, than averaging in at these better risk premiums, but not in the belief necessarily that will be a permanent feature, and that we can't actually have wider risk premiums and a bigger fall in equity markets. And that's the final chart, which is the VIX versus the Move Volatility Index. I think all this says to me is I want to know what's leading what here. Is it the Move Treasury Volatility falling, leading the VIX fall? And does the uptick in the Move Treasury Volatility just in recent days signal that perhaps the best is over for the VIX in the very short term? We shall have to see. Those are the thoughts for this week.